Well, I mean, sentiment carries over, and sentiment doesn't necessarily care that we crossed a certain day in the calendar. I would caution people, and I've said this a couple times over the last few weeks, don't have short-term memory. So if we have a good day, don't let it make you believe that we're out of the woods. Being down before today, 7.3% in the S&P when we were supposed to have seasonality winds at our back is pretty bad. And I think if we finish the year in that camp where we're down more than 7%, even more than 6% in 1 month, that sentiment's going to carry into 2023. I think the risk here is that the consensus seems to be, all right, we're going to have a bad first half, good second half. I actually think the bigger risk then is that we trudge through 2023 and we've got this sort of lasting recessionary behavior and we can't quite make progress.
That the whole year is going to be kind of muted?
Well, I still think we have a stab downward that's pretty dramatic in the first part of the year. I would even say the first quarter, maybe even before the end of January we do that.
Wow.
And then what happens is you look at, an average recession lasts 12 to 18 months. If that's the case, and let's say the recession starts in the first quarter, we still got a long way to go. And if the market can't quite get out of the way, then you could end up in this sort of sideways fashion.
Jim, Piper Sandler today says if the market fails to rally during this time, it has been a precursor for lower prices, that there is, in fact, a follow through. To Liz's point, sentiment's been so bad that you just get, if you can't get anything going to end the year, it doesn't portend well for the beginning.
Yeah, it's hard to argue against that. I will tell you, as an individual investor, as a professional money manager, I'm not sinking a lot of teeth into that. It doesn't move me. And here's why. I'll just give an example today. The NASDAQ, as you mentioned, Scott, is up hard, right? Up 2.7% as we're talking right now. The Dow, which has been crushing things for months, is only up 1.2%. And if I look at some key industrial components, they were negative earlier today. So Boeing and Deere, Boeing's had a great run. Deere's had a great run. They were negative today. And I was thinking about that, and I was thinking, okay, today people want to buy the NASDAQ, and they're using funds from what's worked over the last few months. I think that's a reasonable conclusion from what's going on today, but the problem is it's meaningless to me. It's not something that would change my stance either on industrials or NASDAQs or the markets overall. So what I'm saying to you, Scott, is I agree with what you said and what Liz said. It's not a great sentiment right now. And I wish we were ending on a more positive note. Of course, today's good. We'll see tomorrow. But what I'm also saying is it's not really going to matter to me too much as I look forward a year from now.
Shannon, sentiment, to Jim's point, he used that word, is historically awful. I bring up a stat from Bespoke, which underscores everything. They did their individual investor survey, and in terms of bullish sentiment, this year, 2022, will be the first year in the history of that survey, now that's since 1987, that bullish sentiment was below its historical average every week of the year. It goes to, now, the peak of the stock market was, of course, the very beginning of the year, and it's been down a lot ever since that. So, it's skewed a little bit, but nonetheless, it gives you an idea, to Liz's point, you are entering a new year with sentiment being pretty bad.
Well, it makes a lot of sense, Scott, that sentiment is so bad because we are asking for a belief in resiliency, not just for the consumer, but for corporate management. We're looking for consumers, corporations, to be able to operate in an environment that requires resilience, a resilience that they have not had to face in both, higher interest rates and higher costs in 2023. And so it makes sense that the sentiment is poor because visibility over the course of the next 12 to 18 months, to Liz's point, certainly seems to be one of two problems. One, the Fed remains very, very tight, and we see continued stretching of financial conditions to even tighter levels. Or we enter into a recessionary environment, and the Fed probably doesn't act fast enough to provide that additional accommodation. And so I guess this resiliency really comes back to these wide ranges in terms of earning expectations for this year. We are looking at anywhere from 200 to 235 with a multiple from 15 to 18, right? That's a pretty wide range, and it really requires you to determine which of these companies and which of parts of the consumer behavior will be resilient in 2023. That's why there's such a wide range, and that's why there's so much uncertainty in terms of institutional investors going into next year.